We have a somewhat unique investment strategy in that we focus on a selected number of stocks. We start with a universe of about 50,000 names and ask simple questions about profitability, return on assets, return on equity. And we get the list down to about 1,000. And then we ask some more hard questions to define this investable universe and what we're looking for: stability in margins, stability in return on equity, stability in earnings. Has the company rewarded shareholders with the dividends? Have they raised the dividends? Have they taken on debt? What is the capex like? What is the competition like? And so what we're trying to do is just start with a field of 550 great businesses that we think have durable franchises, great balance sheets, management with a history of rewarding shareholders. And we start there. So since these stocks aren't in abundance, we run concentrated portfolios. We are high quality managers looking for consistent growth, not high growth, but sustainable growth. We are completely benchmark agnostic, which is a hallmark of our investment process. Actually, we think in many cases, especially in emerging markets and international equities, that the index is the risk because of the makeup of the index and the global cyclicality of the index and the lack of transparency in a lot of the names. The selection process actually starts off with a quantitative, more mathematical approach. And then when we define the investable universe, we think that by starting with these virtuous companies with long operating histories of rewarding shareholders, that if we can determine from an analytics standpoint of view, now we're turned over to the fundamental side. Is it sustainable? Let's start with a great business and then determine through fundamental research, is this business, are these earnings sustainable? Because over time, price will follow earnings. And if earnings continue to grow, so will price over time. If earnings implode, price will implode as well. So then the analyst steps in. We have 10 analysts, and we can have 10 analysts because we only follow about 550 names. Knowledge is cumulative in our business. It takes a long time to get to know a company. And since we're right alongside our investors with our personal money, it's serious business. So and since we are benchmark agnostic and can actually hide behind the index and running concentrated portfolios, we need to do a lot of work. And the analyst does a lot of work. Basically, is this franchise sustainable over the next 5 years? And then, what are you going to pay? The companies that we have a certain set of characteristics that runs across all of the companies, whether they be in the emerging markets, whether they be in Europe or in the United States in our global portfolio. So we don't compromise for quality because of the location of any company. We know what we're looking for. So each company has the following characteristics: high return on equity, high return on assets, high return on invested capital, little to no debt, dominant market share, high barriers to entry, an understandable business with durable demand, and 5 years of what we think is sustainable earnings and a good price. And that's the common thread that runs through all of the names that we buy for our clients. Dividends are important in the investment process because they're a reward for shareholders over time, especially when the dividends are raised. But it's not essential to the stock picking process that we have. We like dividends, but we don't demand dividends. So if you had two companies, one growing at 10% with a 2% dividend and one growing at 15%, and they were equal in price, well, the one growing at 15 would probably have the best total return over time. Yes, we do like dividends. They have a way of anchoring the stock price. It's a reward for shareholders, but it isn't a requirement. If we can find a good growing company that doesn't pay a dividend, we're still interested.